Good afternoon, everyone, and welcome to the Colliers webinar for the second half of 2025. My name is Anti, and I'm thrilled to be your moderator today. We have an exciting lineup of speakers and insights ahead. So before we dive in, let's quickly cover a few housekeeping notes to ensure a smooth experience for everyone. To keep the session clear and focused, participant audio and video are disabled. Only your panelists will be visible and audible throughout. Today's webinar is being recorded, so if you miss anything, don't worry. You'll receive the recording and presentation slides by tomorrow afternoon. Look out for QR codes in our speakers' virtual backgrounds, and at the end of the session, these will give you access to contact details, our downloadable reports, and exclusive insights. We welcome your questions. Please submit them via the chat or question and answer box at any time. If we can't address your question live, we'll follow up via email. If you experience any issues, our support team is ready to assist. Just drop your query in the chat box. Your feedback matters. A short survey will be sent along with the webinar recording. Please take a moment to share your thoughts. Now, let's meet our distinguished speakers who will share their expert perspective on Indonesia's commercial real estate landscape. The first one is our Managing Director, Bapak Mike Broomell, followed by our Head of Research, Bapak Ferry Salanto, and we also present Head of our Office Services, Bapak Bagus Adikusumo, our Head of Retail Services, Bapak Sander Halsema, and representing Bapak Rifan Munansa is our Senior Associate Director of Industrial and Logistics Services, Bapak Martua Simarmata. We also joined by Ibu Lenny Es-sinaga, who is our Head of Expatriate Housing, and then our Senior Manager of Energy Efficiency and Environmental Solutions, Bapak Zyotty. To kick things off, our Managing Director, Bapak Mike Broomell, will share a strategic overview of the commercial real estate landscape and highlight key trends shaping the market in the second half of 2025. Pak Mike, the floor is yours.
Good afternoon, everyone. Thanks for joining us. And wanted to start off with just some good news about what's happening in the real estate market. We got a lot of good press. Jakarta did. If you consider being ranked as the most populous urban area in the world, as good news. Apparently, in the past, I think I've seen numbers of around 35 million or so, and it jumped up to 42 million, and that's because the urban areas now are being counted differently and in a consistent way by the United Nations. And they're looking at the urban areas regardless of the city limits, etc. So what's happened is Jakarta area is now the biggest, and that's good press in terms of the real estate market, because the more people, the more housing, the more office space that's needed. It means a lot of good things for the property market. Next slide. This is, again, just an overall view of Indonesia, where it stands in population growth. There are Asian countries here, but it also adds United States to the graph. But obviously, as you've known in the past, Indonesia is the fourth most populous country in the world. And what's interesting to me is that it's the second fastest growing population in Asia after the Philippines. So it's not only a big market for investors, it's a market that has a lot of growth potential. And if you look down at the bottom, of course, some of the more developed countries like Taiwan and Japan are actually reducing in population. So I know that there's a lot of hype about Japan now. because of the interest rates and the cap rates and whatever. But from a long-term demographic standpoint, I think Indonesia looks very positive. Next slide. This is another very positive thing about Indonesia, of course, is the growth in the age where the people are buying homes, people are working in offices. Most of the folks in Indonesia are in that age group, and so you can see senior living might not have a lot of potential in Indonesia, but Indonesians are having lots of kids, and so the population growth is not only it's not only growing, but the population is growing in the right age groups, which is good for the real estate market. Next. Not only is the population growing, but the GDP in Indonesia is relatively positive. I know that the government and President Prabowo has been talking about 8% growth. These numbers are coming from the IMF, both the 2025 and the 2026 numbers for GDP growth. And it's the third fastest growing GDP in Asia. So again, that's a very positive thing if investors are looking at the larger demographic trends. Okay, next. One other thing that was a little surprising for me was the relative stability of the exchange rate. I remember when I first came to Indonesia, investors were very risk averse, and they were concerned about the depreciation of the rupiah to the US dollar. And as I recall, it tended to be around 3% per year. But over the last 10 years, the devaluation of the rupiah versus the dollars has only been at 1.77%. So it's a relatively stable currency, much more than I think people give the rupiah credit for. And again, I think that is an encouraging thing for investors. Next. One of the things that has been and continues to be somewhat of a problem are the interest rates in Indonesia, because the return for investments, what we call the cap rates, have often been lower than the interest rate. So if you were to invest in property in Indonesia and you were to borrow money, you actually had what's called negative leverage. We look at, on this chart, we look at interest rates on consumer loans, and we also look at rates that are on corporate loans on the right. And the gray line is the Bank Indonesia rate. Bank Indonesia has been trying to reduce interest rates to try to prime the pump in the economy here. I think that will continue to happen, especially if the U.S. Federal Reserve reduces the Federal Reserve rate. And that looks very likely because U.S. President Trump is planning on replacing the Fed chairman, and he's putting a lot of pressure on the Fed to reduce interest rates. So I think Indonesia then would likely be able to follow and further reduce interest rates, which I think will be good for consumers and corporations as well. We do see a tick up, though, in the interest rate charged to consumers by private national banks. And we're thinking that that probably is caused by the deteriorating credit of a lot of consumers. I think more and more stories are floating out there where people are getting into debt. They borrowed a lot from online lenders. And we're also even hearing that in the corporate sector, where banks are having an increasing amount of non-performing loans. And we, even as a property consultant, we're being approached by some lenders that have borrowers that are in default, and they're looking to dispose of assets, either that they've taken back or that they are still held by the borrower, and he's having difficulty repaying. So anyway, I think generally speaking, the economy looks good for investors if you look at the demographic data, but interest rates are still somewhat of an issue. And I think we have not seen over the last 12 months a lot of foreign investment. Part of the reason I think for that is because of the uncertainty in the economy, both in Indonesia and in the world. You know, we've had a new president here in the last year. The U.S. also has had a new president in the last year, and the U.S. president is very unpredictable, as everyone knows. And the tariffs have been a concern, and the impact of the tariffs on the global economy have been a concern for people. So we see a lot of investors that are standing on the sidelines, waiting to see how everything works out. And I think next year there'll be a little more certainty than there has been this year. So we're hoping we'll see more investors being willing to come into the Indonesian market, both local investors and foreign investors. Now, moving beyond the economy, we'd like to talk about hotels, and just give you a quick overview of what's happening there, both in the Jakarta market and the Bali market. The slide is entitled Unexpected Impact on Hotels. And as we were looking at this slide, one thing that has been interesting for us is that what is not unexpected, what is very much expected, was the fact that occupancy rates would drop because the government had put a ban on government companies using hotels and renting hotel space. So we see a drop of 5 to 10%, even in some cases as much as 20% drop in occupancy in Jakarta, we believe for that reason. And also perhaps because the economy is not doing as well as people had hoped. But what was surprising to us is that the actual monthly average rate had gone up from what it had been in the prior year, in spite of the drop in occupancy. Next. In Bali, we tracked domestic and foreign tourist visits since before the pandemic. And you can see, obviously, the drop occurred in 2020, 2021. It's been trending higher. It looks as if the foreign visitor numbers are back to where they were. And in fact, we project by the end of the year, they'll be above what they were in 2019. But it looks like the domestic tourism has not fully recovered from what it was prior to the pandemic. You will also notice, interestingly, if you look at the circular chart on the bottom left, that Australia, not surprisingly, continues to be the greatest source of foreign tourists, then followed by China, and then India. And we've seen a continued uptick in the number of foreign tourists coming from India. So that's a good sign for tourism. I think, though, there has been some concern, obviously, in Bali. I was wondering why the domestic market hadn't picked up as much as we might have expected. Again, maybe it's the economic situation of Indonesians, and also maybe it's some of the bad press that is obvious in the Indonesian market. We've had floods. People are quite aware of the bad traffic now in Bali. Foreign tourists may not be fully aware of that yet, and they may continue to come in increasing numbers. But I think eventually things like the traffic jams in Bali will become better known even outside of Indonesia, and that doesn't bode well. So I think obviously the Indonesian government needs to be concerned about what happens with the infrastructure and how infrastructure can be improved. Next slide. These are the occupancy rates in Bali. And again, looks like things are back to where they were before the pandemic. And what's also interesting is the monthly average rates. ADR is over the last 3 years has been up 15% per year in the US dollar terms. So again, that's very healthy. And you'll look at the annual supply on the upper right. Most of the new hotels that are either completed or expecting to be completed are rating themselves to be in the 5-star category. And we listed some of those hotels in the bottom chart. What's also interesting is about half of the new hotels in Bali are being built in Ubud. So that was somewhat of a surprise as well. So we see a number of hotels that are foreign brands, but quite a few that are not brands that many of us recognize. Next slide. And we'll talk a little bit about data centers also. This is one of the healthiest sectors, asset classes in Indonesia. This is a chart that we found that I thought was quite helpful. Just look at data centers around the world. You can see that the US has by far more data centers than any place, almost 4,000 data centers. Indonesia, Asia and Oceania, 2,000, so less than half. And you'll see Indonesia down there as having 182. So it's only 4% of what you find in the US. So I think in Indonesia, there's a lot of room for additional growth in the data center business. But this is kind of showing where we stand compared with the rest of the world. Next chart, please. This, again, looks at Asian countries and the number of data centers by country in Asia. This chart says 184. And you can see where we stand compared with China, Australia, India, and Japan, but we're up there quite a ways. What's even more interesting, not only the number of data centers we have in Indonesia, but the forecast of data center capacity, the growth of data centers in Asia Pacific. And Indonesia is ranked number 2 compared to Malaysia, which is number 1. There are a lot of data centers now in Johor Bahru that are helping to take care of the demand from Singapore in particular. But again, the growth in Indonesia data center capacities is quite encouraging. And we think this is going to continue to be a very healthy sector as we see the exponential growth in AI and the need for data centers to accommodate that growth. Next slide. This is the live capacity of megawatts in terms of megawatts of the data centers in Asia Pacific. And you can see this is by year. It has 2024, 2025, and the top line, which is the dark one, is shown at the top. So you can see there's a big increase even from 2025 to what we expect in 2026 for Jakarta. So this is by city. Next. And these are just some of the data centers that have been announced through this year. We have DCI Indonesia, which is the largest data center company in the country. They've got an existing 36 megawatt data center in Cibitung, and then they're projecting another 119 megawatts. DMAC, Digital has announced a 144 megawatt projected data center in Cikarang. NutraDC and Nexera have the data center in Batam, which is recently opened and expected to grow in size, triple in size. We have SM Plus, which is Es-sinaga Plus, and Korea Investment Real Estate Management with another one in downtown Jakarta. And then we have one that was just recently announced within the last couple of weeks, one that's being built by Princeton Digital Group, 120 megawatt. What's interesting is, with the exception of number one, all the other data centers have foreign participants. DMAC is from Dubai. NutraDC is local, of course, with Telecom, but they've partnered with Nexera from Singapore. We have Simarmata number 4 partnering with the Korean firm. And then Princeton Digital is doing the campus. And Princeton Digital is from Singapore as well. So we're seeing a lot of foreign players come in. And the reason for that is because data centers are very capital intensive. So they need a lot of money, and the foreign investors are the ones that have the money to spend. So anyway, with that, I think we'll conclude and turn it back over to Auntie.
Thank you, Pak Mike, for the strategic overview. Next, we turn to the office sector with Bapak Ferry Salanto and Bapak Bagus Adikusumo, who will provide a comprehensive update on the current market dynamics. Over to you, Pak Ferry and Pak Bagus.
Okay, thank you, Auntie. Thanks for the opportunity and good afternoon to everyone. I'll start with the office sector. Here, overall, what we are seeing here is that office supply up to 2028 will remain quite limited. Most developers are still taking a wait-and-see approach and are holding back on expansion until absorption levels improve. If you look at the chart on the lower left, it's pretty clear that new supply coming into the market is minimal. And this trend has actually been building over the past few years. Developers are being much more conservative today. The main concern is that new building could struggle with low occupancy, especially since existing supply is still relatively large. In fact, between 2025 and 2028, the only new CBD supply is expected in 2028, coming from the completion of Sudirman 2 and Indonesia Tower. And that said, this limited supply is actually good news for the market. With fewer new building comings online, we expect this to support gradual recovery in occupancy levels over the next few years. Next slide, please. Okay, moving on this slide, we can see that occupancy declined quite significantly starting in 2019 and continued for several years after that. We all know that this is a period coincided with the COVID-19 pandemic, and its impact is still being felt today. While we've seen some recovery post-pandemic, the improvement has been fairly modest, mainly because flexible work arrangements like working from home and hybrid models are still widely adopted. And based on the latest data as of third quarter, occupancy in the CBD is relatively healthier at around 75% compared to non-CBD areas. However, with only 1 quarter left before the end of 2025, we don't expect any major movement in the very short term. And looking a bit further ahead, though, over the next 2 or 3 years, with more optimistic, we expect occupancy to gradually improve, potentially reaching around 80% by 2028. If you look at the chart on the right, it shows total office supply by building grade. In the CBD, supply is still dominated by grade A and buildings and premium buildings, while grade B buildings remain more dominant outside the CBD, which makes sense because the location and market characteristic. Next slide, please. Now, turning to rents, historically rental rates were on a slightly downward trend, but over the past year up to now, rents have stabilized both in the CBD and non-CBD areas. And looking ahead to the end of 2025, we don't expect any major changes in overall rental level. And that said, premium building with healthier occupancy are starting to show some willingness to push rent up slightly. However, increases are still quite limited as the market remains very much a tenant's market. Because of this, landlords are still actively offering rental packages and incentive to stay competitive. And over the next 2 to 3 years, we expect rental growth to be in the range of 2 to 3% per year, particularly for upper grade buildings. We are also seeing growing interest in green building certification, which could eventually translate into rental premiums going forward. And the chart at the bottom of the slide also compares rental level between CBD and non-CBD buildings broken down into building grade. Last chart, please, for office. Okay, on the final slide for the office sector, I'll touch briefly on the strata title office market. At the moment, this segment remains relatively quiet as investor interest in office unit purchase is still well below the pre-pandemic level. Because transaction activity is limited, selling price have remained largely flat, and in some cases even stagnant over the past year. And towards the end of the year, there may still be some limited price adjustment, but looking ahead to 2028, we don't see much room for meaningful price growth, especially in the CBD, where buying interest remains soft. And that said, strata title office outside the CBD could be more attractive, mainly due to more competitive pricing and opportunities driven by specific end users' demand. And that's wrap up my overview of the office market. I'll now hand it over to my colleague Pak Bagus Adikusumo, who head the office services, who will continue with the deeper dive into the latest trends and key opportunities for both landlord and occupiers. Thank you.
Thank you, Pak Ferry. Good afternoon, everyone. Thank you for joining our webinar this afternoon, discussing about the second half of 2025. This slide here, we would like to share with you that of all the companies that we assisted and complete their leasing transaction, after the whole process of building option and then concluding the negotiation, at the end of the day, our data shows that a lot of companies decide to renew the lease instead of moving and relocate. Having said that, though, in 2025, we witnessed that more companies decided to relocate is actually more than companies that relocate in 2024. Now, the fact that many companies in 2025 relocate more than staying compared to 2024, this shows that there is a good trend of business confidence and market is improving and economy is also improving. Next slide, please. Now, of all the data also that we have done during this 2025, one thing that is interesting to see in the second half this year, we witnessed that a lot of companies decided to expand instead of downsizing. So the trend of downsizing already stops, and then now the trend of expansion. Now, this also indicates a good sign of economy, climate, and office market. And we believe that we are going to see this trend will continue in 2026. Next slide, please. Another good news is that we also witnessed and recorded a lot of new investment enter into the market. And that is quite in line with what has been informed by, explained and presented by Mike in the first slide about investment in Indonesia. So this new investment showing that there is a good signal market improvement in Indonesia. And then mostly the industry that entered the market is technology and EV industries. So you probably have seen a lot of EV cars from China on the street right now. So China is the country that has invested a lot into Indonesia in terms of EV industries. Next slide. Now, this particular slide is we would like to show with you the criteria about how the tenants or the companies are looking to find a new building, which is part of their office relocation strategy. So our survey shows is that number one is more into public transport and connectivity. So they would like to be close to MRT, LRT, commuter train. So more into employee convenience. The second one is occupancy cost, of course. So it has to be in line with the budget that the company has to make sure it is justifiable to move from one building to another building. And the third one is proximity to client base. So they would like to be located in the building where the client is close for them to go and see and discuss. And also another thing is about brand alignment. They would like to be in the building that align with their brand as a company and the culture, and also would like to be in the location that is aligned with their brand. And the last one is about certified green building. So they mostly multinational companies, part of the ESG initiative, they need and they are must required to be located in a certified green building. So these are the top 5 criteria for companies to look for a new office building. Next. Now, in line with the first criteria, accessibility to MRT, LRT, it shows here that buildings or area that have a train connection or connectivity like Sudirman and Tamrin area, which they have MRT, and then Rasuna site and Gatusroto, which they have LRT. It shows that occupancy rate is much higher compared to Mega Kuningan and Santrio, for instance. There is no railway, so they're a little bit lower. So 76%, 76%, and then 68%. So in the future, we hope the government will continue to improve the infrastructure through the train connection to connect Jakarta and the greater Jakarta. When that happens, it will also improve the economy of Jakarta overall. Next slide, please. What are the opportunities for landlord? Now, landlord has the opportunity to provide flexible lease terms and also to provide fit-out packages, because we are seeing many companies when they would like to move, they try not to put on any new capex. They would like to get the capex from the landlord. So landlords who are flexible in providing fit-out packages will be able to secure the tenants. And also, they would like to be able to move to a more premium building. So they don't want to go into older building. They would like to go to newer, premium, or grade A buildings. And another thing also that it is also possible when the occupancy rate of the building is already achieved 70 or 80%, landlord has the flexibility also to negotiate longer lease and then charge a little bit good rent to offset the previous rent that they charged at a very competitive. So those are the opportunities for the landlord. And then now the opportunities for the tenants. Next slide. So currently condition is still oversupply. So we have a lot of supply that Pak Ferry has mentioned. So tenant in general has a better bargaining power, either renewal or relocation. So it's a good timing for tenants right now that lease will be expired in 1 or 1.5 year time to start conducting the renewal versus relocation exercise. And also what is happening because the oversupply market, occupancy rate down, rental rate also still very competitive. It is very good opportunity to move to a much better building than the existing building and still paying the same rent. So there is no extra cost. So we hope to see that all this activity that I mentioned earlier continue in 2026 because of the stability of the economy and government already recently elected. And things are going so well right now. So we hope to see a better improvement in the relocation activity instead of renewal, new investment, and also expansion of many companies continue in 2026. That will be all from me. Hand it over to Auntie.
Thank you both for those valuable insights. We will now explore the retail sector. Pak Ferry returns alongside Sander Halsema to unpack the latest developments and opportunities in the retail real estate. Take it away, Pak Ferry and Pak Sander.
Okay, all right. Once again, thank you, Auntie, for the time and opportunity to walk you through the retail market condition throughout 2025. Just a quick note before we start. The data we're sharing today is up to third quarter 2025. Since there are still development coming in during fourth quarter, we'll provide a more complete update in our fourth quarter market report, which we plan to release in January 2026. Overall, the retail market in 2025 have been characterized by relatively limited new retail supply. And in this environment, we're seeing more developer actively renovating their existing mall portfolios to refresh and upgrade the overall shopping experience. What's interesting is that this renovation trend is no longer limited to upper end malls. We are now seeing the same push happening in mid-range and even mid to lower tier malls as well. And this really reflects the nature of the retail sector, which is far more dynamic compared to other property segment. Shopping mall needs to constantly innovate, whether it's new concept, better experiences, or a more relevant tenants mix, and regularly review their tenant to make sure they can keep driving foot traffic. And on the chart here, you'll see the total mall supply across Jakarta and the surrounding cities. Jakarta itself is broken into 6 areas, starting from the CBD, South Jakarta, and so on. And we've also included Bogor, Depok, Tangerang, and Bekasi. From the data, it's clear that Tangerang has the largest mall stock, largely supported by strong residential growth in the area. As mentioned earlier, malls with relatively lower occupancy are now starting to renovate to stay competitive. In general, upper tier malls continue to outperform mid and mid-lower tier mall in terms of occupancy. At the same time, we are also seeing smaller scale retail centers, while not direct competitors to large mall, adopting lifestyle and open space concept, especially in area outside of Jakarta. Next slide, please. Okay, moving on this slide, from a demand perspective, tenant expansion is still largely driven by the food and beverage sector. This trend is consistent not only in Jakarta, but also in other major cities like Surabaya and Bali. In particular, Chinese brands have been very aggressive and are planning to open more outlets across multiple cities in Indonesia. And alongside this, we are seeing more diverse tenants mixes across many malls. In some cases, department stores, are even downsizing for their floor area to make room for brands that are more in line with current consumer trends. And overall, mall occupancy has improved throughout 2025 compared to last year. Looking toward the end of the year, there's still room for further improvement, mainly because F&B continues to be the key driver with new concepts and products that are highly appealing, especially to younger consumers. And if you look at the chart at the bottom, it shows vacancy rates for mall classes. The data clearly indicate that mid and mid-lower tiers mall still record the highest vacancy levels, both in Jakarta and outside Jakarta. On the other hand, premium malls continue to perform very well, with vacancy generally below 3%, while mid-lower tiers malls sit at around 16%. And this highlights the relatively stronger performance of upper tier and upper mid-tier malls. Next slide, please. Okay, on this final slide, we can see that malls with strong occupancy level are starting to become the main driver of rental growth, particularly in Jakarta, while rental increases are still quite modest compared to previous years. And this trend is clearly led by upper-end malls rather than mid or lower-tier malls. Outside Jakarta, base rental rates remain relatively stable, with no major changes observed so far. And from a service charge perspective, both in Jakarta and across Bodetabek area, we are seeing a gradual upward trend. And this is mainly driven by higher operating costs and inflation adjustment. And that said, overall rental rates remain generally stable through the end of 2025. Looking ahead, we expect developers to start selectively adjusting rental rates in line with the improving occupancy. And on average, rental growth is projected at around 2% per annum, and particularly for malls with strong occupancy performance. Just a quick note that cost of business occupancy shown here combine base rent and service charge, and this is naturally varies by location. And that's conclude my overview of the shopping mall market in Jakarta and greater area. We also have report available for Surabaya retail market, and we are planning to release the dedicated Bali retail report in early 2026. With that, I'll hand it over to my colleague, Sander Halsema, who will take us through the latest trend and key opportunities in the retail property sector. Thank you.
Thank you, Ferry. And good afternoon, everybody. Thank you for joining the last webinar of this year, actually. If we look at the real estate side of the retail business, we've seen 3 new malls starting to operate in 2025. Lifestyle Mall Agora Tamrin 9, which is combining mostly F&B with sports and entertainment. We saw Living World Crown Wisata in Bekasi, and most recently K Mall in central Jakarta. For 2026, we expect 2 new shopping centers to start operation with Lipo Mall East Side in central Jakarta and Sumarekon Phase 2 in Bekasi. And then if we look further ahead to 2028, there's 2 additional new malls that will be opened, both located in Tangerang. Next slide, please. Like Ferry also said, we increasingly see developers investing in their existing assets, either to rejuvenate them or to further enhance the visitor experience. A couple of well-known recent examples are, of course, Lipo Mall Nusantara, ITC Mangga 2, with the new concept, The Circle, featuring a more modern design, food court, fashion, and an interactive area. Other interesting examples are Pluit Junction, which will be fully renovated and repositioned. The recently announced renovation and rebranding of Neo Soho into Central Park 2, and the consistently high-performing Mall Kelapa Gading and Gavoy, with Sumaricon that continues to invest in refreshing its atmosphere. And all these efforts are really aiming not only to better serve current customers, but of course also to ensure long-term relevance and appeal for the future generations. Next slide, please. Now, if we look at the retail market, the Indonesian retail market, it continues to demonstrate resilience, supported by consistently high foot traffic across the different malls and shopping centers here in Jakarta. However, we also see consumer spending is under increasing pressure as households remain cautious amid rising living costs and economic uncertainty, obviously. So as a result, while visit frequency remains very strong in Jakarta, average transaction values have softened. Essential categories such as food and beverage, tobacco also continue to dominate retail sales, reflecting a focus on daily necessities. And in contrast, discretionary spending is under a lot of pressure, with weaker demand for big ticket items, including cars, consumer electronics, and household appliances. And we also, over the course of last year, received feedback from F&B brands, from fashion retailers, that the average ticket sizes have decreased. So retailers are therefore really adapting their strategies to prioritize value, prioritize promotions, and essential offerings. Next slide, please. Well, if we look at the main challenges for retailers here in Indonesia, first, and it's a well-known one, the logistics and supply chain efficiency remains a major obstacle due to the country's vast geography and fragmented infrastructure, making a nationwide expansion complex and oftentimes very costly for a lot of retailers. Secondly, Indonesia's regulatory environment is very complex and often changes, and that creates additional barriers, in particular for foreign retailers, in areas such as licensing, ownership, import of goods, and compliance. And thirdly, the rapid evolving consumer expectation require retailers to continuously adapt their product offering. They need to improve convenience and strengthen their omni-channel capabilities to meet the growing online and digital demand. Next slide, please. Now, a couple of retail trends that we have seen. First of all, Asian retailers, in particular from China and Japan, are increasingly entering Jakarta's retail market. Geopolitical uncertainty has accelerated this shift and prompting many brands to refocus on Southeast Asia, with Indonesia standing out due to its large population, its growing middle class, and the position as the region's largest economy. I already mentioned it before, but mall repositioning and experience-led formats. So shopping malls are actively repositioning themselves by introducing experimental zones, more carefully curated tenancy mixes. And these strategies aim to respond to a changing consumer preferences. They aim to improve occupancy levels or to maintain the mall's position as the prime retail destination within its own catchment area. Shifting consumer behavior and the rise of local brands. Indonesian consumers are increasingly drawn to experiential retail concepts and niche brands, with the growing popularity of local brands as a notable trend, driven by demand for high quality but affordable products with a strong local relevance and identity. And then one that is also very important, and I'm pretty sure all of you have noticed, sports-driven retail concepts. So the rising popularity of sports among Jakarta's population has been recognized by many mall operators. Sports facilities encourage a healthy lifestyle and social interaction, making them a very attractive traffic driver. And as a result, sports venues are increasingly becoming anchor tenants in a lot of shopping malls, with padel leading as the fastest growing sport. but also other sports such as pickleball, basketball, and badminton. We increasingly see opening at different shopping centers. Next slide, please. So to summarize, and also looking ahead to 2026, Colliers continues to see the following key opportunities for landlords. One is in investing in existing assets. So continued investment in existing retail assets remains a strong opportunity for many landlords. Rejuvenating, upgrading malls through refurbishment, improved layouts, and better tenancy mixes has proven an effective measure in maintaining its relevance, increasing traffic, and extending the life cycle of well-located assets. And then experiential integration, integrating experiential elements such as entertainment, sports, all discussed, and diverse dining concepts with traditional retail is becoming increasingly important. These experiences encourage longer dwell times, so people stay longer in your mall, and also repeated visits. Next slide, please. Now, for retailers, we have identified the following key trends for 2026. Indonesia's large and young population continues to offer strong long-term growth potential, supporting a positive outlook for the retail sector. However, retailers must adapt to evolving consumer behavior with increasing expectations around omni-channel experiences, sustainability, access to high quality, responsible produced goods. And in addition, a closer collaboration with shopping malls through co-branded events and experiential marketing campaigns will become increasingly important to drive engagement, to strengthen the brand's visibility, and connect more effectively with consumers. So I think that wraps up my presentation. Thank you very much, and I wish you all a Merry Christmas and a happy 2026. Thank you.
Thank you, gentlemen. Our next segment focuses on industrial and logistics. Pak Ferry will lead the discussion, followed by Bapak Martua Simarmata presenting on behalf of Pak Rifan Munansa. The stage is yours, Pak Ferry and Pak Martua.
Okay, thanks again, Nanti. And let me move on to the industrial sector with a main focus on the industrial estates. Just to share a quick update, starting next year, we plan to separate our industrial report and our warehouse report into two standalone publications. The idea is to go deeper and be much more specific to each subsector, gets the attention it deserves. And in general, I've mentioned this in a few forums before. The industrial sector has been the fastest to recover compared to other property sector. If we look at the office or vertical residential, those sectors are still in the early stages of recovery, while the industrial sector, on the other hand, is already much further along. Using property cycle analogy, we see the industrial sector at around 10 o'clock position, which means that it has already entered the acceleration phase. The signs are quite clear. Industrial land sales are picking up, even though this cycle has taken longer than usual due to the impact of COVID-19 a few years ago. On this slide, you see the performance of industrial estate in Greater Jakarta area. Traditionally, Greenland or GIIC often tops the limit list in terms of the Greenland often tops the list in terms of the land sales. But in this period, Modern Chikande and Arta Industrial here recorded the highest sales, with Greenland coming in third. This shift was mainly driven by a few large transactions in those two estates. You can find the detailed breakdown in our quarterly report. Next slide, please. Okay. Here we are looking at annual industrial land absorption, which we've tracked all the way back to 2006. What's interesting is that each cycle have been driven by different sector. If you look at the graph here, between 2010 and 2012, absorption was mainly driven by the automotive industry, and then that was followed by a phase dominated by logistic. After that, data center became the key driver, and starting 2023 onward, electric vehicle EV have taken the lead. As of the third quarter 2025, total land absorption is already close to the level we saw in 2023. However, based on our full year projection, it's unlikely to exceed last year's number. The main reason is that in 2024, it was boosted by one exceptionally large deal, the acquisition of around 108 hectares in Subang by BYD, a Chinese EV manufacturer, giving significantly lifted last year absorption figure. Next slide, please. Okay, in this slide, we're looking at the sector composition of buyers or tenants throughout 2025 up to third quarter. Overall, the machinery sector have been the most active, followed by textile and then data center. Although data center are not as dominant as they were in previous years, what stand out this year is that activity have been much more evenly spread across sectors rather than being heavily driven by just one segment like logistic, data center, or EV. Specifically for data center, we are seeing that not all industrial assets are suitable for this type of development. As a result, future data center expansion is likely to increasingly take place outside conventional industrial estates. Next slide, please. Okay. From a land price perspective, we haven't seen any major changes overall. That said, some industrial estates have started to consider price adjustment, especially those with limited remaining land and strong and consistent sales and strategic location. And these estates are also beginning to plan for further expansion. Looking at supply and development area, we're seeing growing activity in emerging industrial location beyond Jabodetabek and Karawang, particularly in Purwakarta and Subang area. And this is largely driven by improving infrastructure connectivity, including better toll road networks and the planned connection between Cipali Toll Road and Patimban Port. With this connectivity improvement, several developers have already started planning new industrial estate development in this area. Beyond Subang Smart Politan, for example, we are also seeing planned development by the Barito Pacific Group near Patimban Port, along with several other expansion projects in Purwakarta that are already underway. And that's wrap up my overview of the industrial sector. Next, I'd like to invite my colleague Pak Martua Simarmata, who will continue with the insight on market condition from the industrial property agency perspective, including current trend and key opportunities for both occupiers and landlord. Thank you.
Thank you, Pak Ferry. Good afternoon, everyone. Now I'm going to explain or talk about the industrial and logistics sectors. The first one we're going to discuss is about the current market conditions. As you can see on your screen, we have about 1,434.3 Indonesian trillion investment, which 45% of it or equals to 644.6 trillion Indonesian rupiah comes from foreign or FDI, which the rest, about 55% or about 789.7 trillion Indonesian rupiah is from domestic investment. The leading contributors in this Q3 2025 comes from China, Hong Kong, Malaysia, Singapore, and United States. And the industry is still focused in household and then warehouse or logistics, consumer goods, and also data centers. Next, please. Yes, this current market condition we can explain into several conditions. The first one is regarding the factory rental. We noticed that many investment, especially from China, before they enter into the market, they would like to lease or rent factory rental before they make or committing to investment. That's number one. Number two, we noticed that some relocation, especially in labor-intensive sectors, which many shoes makers, garment, they are relocating to Central Java due to lower minimum wage rates. And that creates some asset disposals opportunity or conditions where after they relocate to the new factories in Central Java or area with low minimum wage, the company and then decided to dispose their current assets. That's we noticed in the market. Next. When we're talking about the trends in industrial and logistic, we still consider Chinese companies are among the most active players in the market. And then we can also see that beyond automotive and EV, the following sectors actively acquiring land in Indonesia, which is for manufacturing, FMCG, renewable energy, and also logistic and warehousing. Next, please. For the trends, the development area, now it's shifting. Previously, Greater Jakarta closer to Bekasi, now due to the development, they're going toward east area from Bekasi to Purwakarta and Subang. These are the shift of growth from Bekasi to Purwakarta and Subang toward east area. That's the trend of the development now. Next. We also see the trends of standard factory buildings. As mentioned earlier, many investors, before they commit to purchase or invest directly by purchasing the land, they prefer to have factory or small workshop settled and lease them first to see the market before they actively purchasing. So these trends create raising in standard factory building, plug and play modular digitally enabled facilities that become a potential catchment for the small medium enterprises. Next. The next trend is regarding the growing or the movement of the toward the east area, which is for warehousing demand. So after Bekasi, we can see because of the factory start moving to the east to Karawang, to Purwakarta, that also attract the needs for warehouse in that area. The trends we basically we can see that the demand for warehouse basically follow the production area to the Bekasi and Karawang. Next. As for the opportunities, this slide basically shows you about Asia's tariff map in November 2025. we can see that Indonesia, actually with Cambodia, Malaysia, Philippines, Thailand, at the same tariff, which is 19%. It's lower or better than Vietnam, 20%, India, China, and Laos, which is they have higher tariffs. We can see by this, it will create opportunities for companies for investment to come to Indonesia because of this lower tariff. Next. However, as expected high FDI due to tariff regulation, we also cannot overseen the fact that we also have a huge domestic market. This will be a special, as mentioned by Pak Mike earlier, the opportunity for investment where they can create the factory here, they can produce here, but they also can directly sell to Indonesian market in Indonesia. That's number one. Number two, we can see the opportunities for the developer. The size opportunities in Bekasi and Karawang because of the going toward east. So we can see these new emerging corridors in Subang, in Purwakarta, as the development area grows toward east. The other thing is the potential development for warehouse, logistic, and factory. Used to be close Jakarta in Bekasi. Now it's growing also towards to Purwakarta and Subang, which is closer to the production area, as well as the investment of ready-to-use facilities due to the direct foreign investment, which are looking for standard factory building, which they can arrive here and they can start producing. We can see also this as a big opportunities for Indonesian market. I think that will wrap information regarding industrial and logistics. And back to you. Thank you.
Thank you both. We now turn to the apartment sector and expatriate housing. Pak Ferry will share market updates, followed by insights from Ibu Lenny Sinaga. Over to you, Pak Ferry and Mbak Lenny.
Okay, thank you. Now I'll move on to the last sector I'll be covering today, which is apartment or vertical residential. I have several slides here to deep dive the overall apartment market. As you might all be aware of, the apartment market hasn't fully recovered yet. And that said, we are starting to see some interesting dynamics, especially on the supply side in South Jakarta, which continues to be an attractive development location, particularly for the middle to upper middle segment. In this section, I'll walk you through a few key points: supply trends, the extension of the VAT incentive, or we call it PPN DTP, price movement, buyer behaviors, and of course, the key challenges and opportunities in the market. If we look at this first slide, you can see the annual apartment supply trend since the pandemic in 2020. Supply has corrected quite significantly and has remained relatively subdued ever since. This clearly reflects a much more cautious approach from developers when it comes to launching new projects. And this is not just happening in Jakarta. We are seeing the same pattern in other major cities like Surabaya. And looking a new supply between 2025 and 27 by both segment and location, supply is still largely concentrated in the middle and upper segment. From a geographic perspective, South Jakarta stands out as the largest contributor, highlighting developer preference for areas with stronger purchasing power. Next slide, please. Okay, now from a payment method perspective, we are seeing a very interesting shift. A few years ago, cash installment or developer-backed payment scheme were still quite dominant. Today, more buyers are turning to mortgage or KPA facilities from bank, and this shift is largely driven by attractive interest rates, especially during the first 3 to 5 years, as well as longer loan tenures. Down payment has also become more flexible, typically ranging from 5% to 30%. We are also seeing change in the buyer profile. In the past, investor accounted for more than 60% of the market. Today, the split is much more balanced. Investors now make up around 52%, while end users are gradually increasing their share. In terms of absorption, the middle segment remains the main contributor, although overall take-up has been relatively limited since 2020. Next slide, please. Okay, in this slide, we are looking at the strata title apartment market. Average prices have remained relatively stable, hovering around 36 million per square meter with a moderate growth, particularly in the middle segment where absorption has been better. Mortgage continued to be dominant financing method, and on the annual basis, absorption up to third quarter 2025 is about 7% higher than in 2024. However, developers are still largely focused on completing existing projects rather than launching new ones. Looking ahead, we expect additional supply to come mainly outside the CBD, with a more even spread across South, Northwest, and East Jakarta. And the middle to upper middle segment are expected to continue dominating the market. Next slide, please. Okay, this is a service apartment segment where performance has clearly improved. Occupancy has increased by around 2% quarter on quarter. In 2025, we expect CBD occupancy to continue improving, while areas outside the CBD may face some pressure due to new supply coming in. Rental rates are also trending upward, which has helped lift developer sentiment toward the segment. On the supply side, new projects remain limited. Notable additions include a project in Sleepy with around 150 units, and Capri managed by Frasers, which is expected to come on stream in 2027. Next slide, please. And looking at the national distribution of apartment, supply is still heavily concentrated in Jakarta and its surrounding areas, followed by other major cities like Surabaya, Semarang, Medan, Batam, Balikpapan, and Makassar. And that said, the number of unsold units remains quite significant, as you can see in the darker blue there. And this continues to be one of the biggest challenges the market needs to address going forward. Next slide, please. Okay, when we break things down by unit size and price, it becomes clear that each apartment segment has very different characteristics. For example, lower segment units in Jakarta typically range from 10 to 18 square meters, while in satellite cities like Depok, for example, unit sizes can be even smaller. And this size variation directly affect price ranges, both minimum and maximum across each segment. In the upper segment, price differences become even more pronounced as they are highly dependent on unit size, layout, and specification. Next slide, please. If we focus on Jabodetabek, it's very clear that the middle segment has the largest stock, both in terms of unit already sold and unit that remain unsold. And it's these unsold units that represent the core challenge in today's apartment market. Moving on to the next slide, please. Okay, now let's take a closer look at what the real challenges are in the residential sector, especially apartment, when it comes to vertical living or apartment. First, let me draw your attention to the table in the top left corner. You see that we have broken the data into three key time periods. The first one is 2015 to 2019. This was what we can call a fairly normal period. In fact, it was more or less the golden era of apartment right before the pandemic hits. And then the second period is 2020 to 2025, which represent the post-COVID phase. For each of this period, we are looking at the average annual supply and absorption. Just to give you an example, between 2015 and 19, average apartment supply coming into the market was about 16,300 units per annum, but absorption was only around 8,000 units annually, so roughly half of the supply. Now, if we come into the post-COVID period, we can see that the average annual supply dropped quite significantly, but at the same time, absorption also declined. So even though fewer units were being delivered, demand didn't really recover in a meaningful way. And what does that lead to? It results in a fairly large stock of units, both units that are still unsold and units that have been sold but are not occupied. What interesting is that we look at the prices. Apartment price growth over the past few years have been very limited. In theory, this should actually create a buying opportunity, especially in the secondary market, where prices can be quite attractive. But on the ground, we are seeing that many owners actually feel that owning an apartment has become more a burden, and that's mainly because operating costs are relatively high, and also many of these units don't really generate income, or in some cases aren't even occupied. So the big question is, why does apartment demand remain weak? One of the key reasons goes back to the buyer profile in previous years. As I mentioned in the earlier slide, the apartment market was heavily dominated by investor type of buyers, and a large portion of them were actually repeat buyers, the same investor coming back again and again. And the issue now is that the yields they are getting no longer meet expectation. Return tends to be lower than anticipated, and in some cases even lower than relatively safe investment option like deposit or bonds. When you add high property holding costs into the equation, it's easy to see why many investors are choosing to sit on the sideline instead of buying again. And this overall explains why the vertical residence sector remains relatively stagnant today and why its recovery has been much lower compared to other property sector. Next slide, please. Okay, that said, there are still several strategies and opportunities worth exploring. And now we are discussing the opportunities. This include build to rent models, converting units into co-living concepts, and offering micro units for young professional and migrant workers supported by shared facilities. There's also potential for adaptive reuse, such as converting part of existing development into service apartment, student housing, or corporate housing. Rent to own scheme could help end users who aren't yet eligible for full mortgage financing. And of course, service charge level remain a key issue. Bringing this down would significantly improve the appeal of vertical living compared to landed housing. Last slide, please. Okay, from a policy perspective, there are a few areas where government support could make a real difference. Multi-year PPN DTP or VAT incentive would give developer greater certainty in project planning, and faster permitting processes tax incentive for build rent to SIM and stronger support for the rental market also critical. On the financing side, lower down payment, longer loan tenures, interest subsidies, and continued strengthening on the FLPP program. Also, along with the incentive for first-time home buyer would go a long way in improving absorption. And that concludes my overview on the apartment sector. Thank you very much. And next, I'll hand things over to my colleague Lenny, who will walk us through the latest development on the expat housing market. Over to you, Lenny. Thank you.
Thank you, Pak Ferry. Okay, what's wrong with my video? Okay. Okay, good afternoon, everyone. I'd like to now discuss about expatriate housing market. As you'll see, this segment faces unique challenges compared to the local market with limited supply, evolving corporate budget policies, and shifting tenant preferences that are reshaping demand. So now we start with the market condition, the supply. These slides explain the current supply situation. The expatriate housing inventory remains very limited to existing properties like apartment and compounds. And then we'll see that about 90% being fully furnished. So no new expatriate-focused developments have emerged, and family typically prefer compound living arrangements. Next slide, please. Okay. This slide shows that the top 6 neighborhoods for expatriates housing, displaying their geographic distribution and property types. The most popular areas are Sudirman, SGBD, that's 4 apartments, and Kebayoran Baru, 4 apartments and stand-alone homes, Cilandak for compounds, Pondok Indah for mixed properties, Kemang for stand-alone houses, and Cipete for compounds. As you know that right now that the market for apartments that's still the tenants market, and for housing, landed housing, still the landlords market. So same as the last year. Next slide, please. Okay. So for this, the rental rate very challenges because many corporations haven't updated their housing budget, creating a widening gap between market prices and corporate allowances. Additionally, some company budgets now include all taxes, VAT, and income tax. And as you know, the currency fluctuation between USD and rupiah significantly impact affordability and payment preferences. Next slide, please. For this slide, that the expatriate strongly prefer fully furnished properties because corporate policies no longer allocate separate furniture shipping budgets. So some companies now require furnished housing to be included in their accommodation packages. So right now that we've seen that a lot of the company requested that furnished condition for their expatriates. Next slide. Okay, in the business industries, here that the trends expatriate presence in the electric vehicle sector is declining, while mining, oil and gas and manufacturing sectors are experiences growth in expatriate activities and housing demands. Next slide, please. Okay, for the trends, this identify a key trend where many expatriates struggle to find a suitable accommodation within their budget constraint, leading to price increases driven by the high USD exchange rates and inflation. So this is causing a shift from traditional landed houses to more affordable apartment options. Next slide, please. So now we're in the opportunity slides, what we see in 2026. So the forecast, two key opportunities. Property owners are diversifying beyond just leasing to include property sales, and demand may see moderate growth fueled by increased expatriates arrivals linked to the activity in the oil and gas sectors. Next slide. And this highlights renovation for this opportunity for the owner of older properties, particularly houses, should be flexible with the renovations to meet modern design expectation. Updated, renovated homes can command premium rental rates in the market. That's all. And to summarize, the expatriate housing market was supply remains constrained, and budget pressure are causing a shift towards apartment. We see the opportunities ahead in 2026, particularly in sector like oil and gas, and for property owners willing to renovate and adapt to modern expectation. Thank you. Back to you, Auntie.
Thank you, Mbak Lenny and Pak Ferry. Now, to close our speaker sessions, Zyotty Tamsil will guide us through emerging trends and opportunities in sustainability within real estate. Zyotty, it's all yours.
Thanks, Auntie. Hi. So recently, Colliers has released its Global Investor Outlook for 2026 for the APAC region. This highlights in the survey for the regional investors what they see as challenges and opportunities. In blue, we can see those are the opportunities that are perceived, and the gray ones are the challenges perceived. We can see that as the top opportunity that investors see is the technology readiness and digital maturity in the region. And for the corporate real estate, the main challenge would be higher operating costs, including higher energy costs that are being predicted. If we look at this in a more holistic way, that we can see we can always utilize our opportunity in terms of technology readiness and digital maturity in the region to also help combat the higher operating costs for the assets. Next slide, please. Now, for the other market condition, we'll look at this from the regulation side. We can see from the Ministry of ESDM that they have continued with further socialization efforts for their energy management regulations. This includes energy use reporting for commercial real estates with energy use of roughly 600 million rupiah per month. That also will include the requirement of rough energy efficiency roadmap. On the flip side, we can also expect some regulation enhancements in the coming years in terms of ESCOs or energy service companies, since the government has also held multiple public consultation sessions recently. PropTech from this regulation enhancements is also predicted to play a bigger part in the government's plan to focus on energy usage in terms of chasing the net zero and NDC goals from Indonesia. Next. Now, from the tenant side, Colliers have recently released its 2026 Workplace Insights for the region. We can see that over 70% of the correspondents have shown that they expect the landlord to play a very significant role in terms of helping them achieve their sustainability goals. This includes that landlords and developers will continue to be the main drivers in terms of sustainability in Indonesia. Now, if we go to the next slide, we can see that regularly sustainability have a few or quite a lot of goals and initiatives that are hard to be measured. But one of the most easily measured way to do sustainability is through utilities, or in this case in particular is energy. If we look at the recently released capital and investment report, they have looked into how sustainability has returns on their operations. One of their things that have seen that there is a very high correlation between green capex and expenditures and resulting in lower electricity bill. It is almost a guarantee that every dollar spent on retrofitting for energy efficiency will give us a pretty good return. And the annual savings expected from those initiatives are also very measurable. Now, of course, in terms of chasing energy efficiency for sustainability and also for cost measures, there are three main challenges that we have seen. First and foremost is, of course, the high upfront capex needed to do retrofitting, to deploy controls and everything else. Secondly, is difficulty in terms of integration in the market and integration into the existing building operations. And lastly, of course, we have also seen that there are skilled workforce shortage in Indonesia to be able to tackle energy efficiency correctly. Now, in terms of the main hurdle of high upfront capex requirements, we have seen with the upcoming or expected regulation changes that alternative schemes such as ESCO or saving sharing methods will grant access for landlords and developers to be able to achieve higher energy efficiency through retrofitting, through advanced controls and everything else. And that will directly translate to better efficiency in the building that results in, first and foremost, of course, cost savings in terms of lower energy bill. And that translates linearly to also lower carbon reduction, carbon footprint in their scope 2 of their asset. Now, if we go to the next slide. Now, this is some of the things that we have seen in the market in terms of chasing energy efficiency for sustainability and, of course, for cost-saving measures. First and foremost is the optimization on the left side. This usually will tap into the existing infrastructure of BMS and BAS in the building to make automatic real-time adjustments to the HVAC operations, including chillers, air side equipments, and everything else from real-time data. And of course, also usually from ambient outdoor temperatures. This also has a very nice side benefit of not adding any additional workload to the engineering team. And on the flip side, it actually reduces workload from the engineering team. The second one that we have seen also is to focus on reducing the runtime for compressors. This usually utilizes some sort of AI to help minimize short cycling and also to minimize the runtime of compressors, which is usually one of the biggest energy use in terms of HVAC. And now, why do these two solutions that we've seen on the market usually focus on HVAC is because regardless of the sector of commercial real estate, especially in office, retail, hotels, convention centers, and everything else, usually HVAC contributes a very large amount of their energy use. And that is why usually we see companies and developers focus on that aspect. Next slide. Now, for opportunities, of course, from the energy efficiency and sustainability initiatives and retrofits, landlords have now the opportunity to continue to invest in green retrofits for older buildings to meet ESG standards that are expected from tenants and also from usually internal roadmaps. Now, that will also directly translate into a potential increase in net operating income and increased asset value from the lower electricity bill in terms of energy usage intensity. And of course, also usually then results in better tenant comfort in terms of the temperature range inside of the building. Usually by implementing technologies to achieve sustainability goals, landlords can also then gain data transparency on energy consumption and carbon footprint that they can choose to share with the tenants if required. And lastly, for developers, marketing sustainability as a value proposition continues to be an opportunity, especially for non-grade A and non-grade premium office buildings. Next. On the flip side, for the last opportunities is for the tenants. I think as Bagus and Ferry has mentioned, the office sector continues to be tenant-driven market. And now this is probably a very good time for them to secure places that align better with their ESG commitments before we see any significant rental rates rises. Usually by getting those spaces with better sustainability measures, companies or tenants can also then gain lower carbon footprint for their office operations and then also gain better comfort, health, and well-being for their employees. Lastly, we have also seen companies continue to use sustainability features to enhance employee engagement and retention. Usually this is through the sustainability certifications of the building or the interior space itself, such as Green Chip, LEED, Green Mark are the upcoming Bangunan Gedung Hijau from the PU Ministry. Now, I think that's all from sustainability side. Thank you.
Thanks, Z. Thanks, Z. As we wrap up the presentations, we'll open the floor for Q&A. However, we're very sorry, we're already kind of like 10 minutes far from our targeted finish time. So we're going to open for 2 questions, and we're going to discuss 2 questions here, but don't worry, we've already archived all of your questions. Our marketing and communications team will be in contact with you with all of the answers via email. We're going to the first question from Ibu Rina Damayanti. This is about retail. So can I have Sander on the spotlight, please? Ibu Rina asked question, what does it mean by experiential zones or retails? What are the examples, Sander?
You could compare it to retail 20 years ago, where you just had a store of a certain brand and they were selling their products. Well, now you see, just to give you some examples, and this can be done either in the store or larger in the mall, in the atrium of the mall, for example. But let's say you have a sports brand that is launching a new, and we've seen this example in Indonesia, in Jakarta. Let's say there's a sports brand that launches a new padel shoe. Instead of just launching it in the store, they build up a temporary padel court in the atrium of the mall and organize some sort of friendly tournament for everyone to try out this new type of shoe. And so instead of just, like I said, instead of just launching it in the store itself, they build a whole experience around it to create brand awareness, to make sure people can try it. And oftentimes they invite KOLs, so key opinion leaders, influencers, to those events. They give those shoes away for free. And so there's a lot more to it than just simple product launch. Other examples could be a cosmetica brand that organizes a certain type of new product, and in the atrium of the mall or in the store, they have makeup artists that teach people how to use this particular new product. That kind of, or a fashion brand that people try on their new product through virtual reality classes. So digitally, people can fit on clothing and all that stuff. So it's basically retail, I guess, evolved from a bit of a one-dimensional thing where you go to a store and buy stuff to a much larger experience around products. So people are much more engaged, care about it on social media, and I guess that's and malls and retailers oftentimes work together also for malls to increase traffic. So that's the type of thing we need.
Okay, thanks, Sander. I hope that answers Ibu Rina's questions. Moving on to our second questions, which is for Pak Bagus. This is a question from Bapak Igede Gita Di Pramana from Elman. Pak Bagus, given current market conditions in Jakarta CBD through 2028, does new high-rise supply have better prospects as a standalone office development or as a mixed-use project? And should the office component be positioned as premium or grade A? Pak Bagus.
Okay, very good question. Number one, about building a new office building in Jakarta, as Pak Ferry has shared about the office market condition right now, we are in the oversupply mode. So in order to build a new office building right now, because of the oversupply situation, it's probably going to be very, very, very challenging to fill up the space. So it is better to wait until the market comes back and then the demand increases, because we don't see any new supply coming into the market 25, 26, and 27. So the very at least 26, 27 will see the development of the office market. Now, going back to the questions, whether or not to build standalone or mixed use, based on my experience, a lot of multinational companies, which is been the main domination of the office demand, they still prefer to be in the standalone building, mainly due to the security. So if it is standalone building, the access in and out is more controllable compared to mixed use. Because when you are in a mixed use, there is already retail, shopping mall, so there's not going to be easy to in and out, you know. So the type of companies that will move into the office building in a mixed use or standalone building is different. But if the market is very good, meaning that supply and demand are balanced, which is not balanced right now, but balanced, then the absorption of the demand for office in a mixed use or office in a standalone, pretty much different target market, and then pretty much it will be absorbed. As you can see, probably right now we have only 4 or 5 mixed use development where there is office, right? There is Plaza Indonesia, there is Central Plaza Senayan, right? So there is not many of them, and why is that? Because standalone building is better than, I mean, it costs less than building office building as part of the mixed use. So the answer is no difference between building a mixed use or office building, but it is recommended until 2028 not to build a new office building because of the oversupply condition. And then the second one is whether it is premium or grade A, as the land price is already very expensive in CBD Jakarta. So I always recommend a developer to go with premium. And in the good days when the condition of office supply and demand is balanced, is an oversupply like right now, the rental rate could achieve, premium building could achieve up to $45 to $55 per square meter per month, compared to grade A, which is below $30 to $40. So while the land that been bought is very expensive, especially in the CBD Jakarta, so we always recommend to go premium, large building, large floor plate. So when economy comes back to normal, supply and demand is balanced, then the rent and the performance of the office building can be at the maximum level if you only building grade A building. I hope that answered the questions.
Yes, thank you, Bagus. Due to time constraint, we're already like 28 minutes more than when we're supposed to close the webinar. So we're going to close the question and answer session. Don't worry, our marketing and communications team will liaise with you directly to those who have sent out your questions, both in the registration form or in the question and answer box. We will answer your questions through email. Thank you all for joining us today and for your active participation. Before we conclude, here are a few reminders. In your screen, you can see a More from Colliers QR codes. You can either contact our team of experts who is the speakers in our webinar session. And also you can subscribe to our market reports or our news flash, which is a bi-weekly news flash, or just basically download our latest thought leadership. You'll receive an email tomorrow with the webinar recording and presentation materials. And you also, if you have any additional question, feel free to reach out via email. Please take a moment to complete our short survey along with the email tomorrow. Your feedback helps us improve and deliver even more impactful sessions. On behalf of the entire Colliers Indonesia team, thank you once again. We look forward to connecting with you soon. Thank you and have Merry Christmas to those who celebrate and Happy New Year. Bye-bye.